Mahesh Nandurkar joins us now, Head of Research and Managing Director with Jefferies. Mahesh, good morning. Thank you for joining us. So Mahesh, all the global and local brokerages are now saying that it's time to buy India. Is it really time to buy India?
Sorry, I think the valuations have clearly come back to a more palatable level. We are trading at 17 times 1 year forward earnings, and this is in line with a historical average. In fact, if we look at the valuation comparison with the other emerging markets and other Asianics, Japan kind of markets, that's also in line with the historical averages. So I think the valuations have come down to back to historical average levels. The second point is that the macro situation also, from an India perspective, is also actually reasonably okay. I mean, we are looking at the rate cycle peaking out. We are also looking at the current account deficit for this year and also for the next year is turning out to be much lesser than what was initially feared. The oil prices have also corrected. The commodities are down. So in many ways, I would say one should be looking at investing in the markets from a longer term perspective. Yes, from a shorter term perspective, things are still quite confusing. Especially from the global perspective, there are likely to be some more negative news coming out from elsewhere in the world. But I guess the long term investors should be adding here.
Mahesh, so are we in for a slow second half and a good second half?
Yeah, I think it looks like, because the near term, probably is still a bit sketchy, for the markets, and as I mentioned, more because of the global developments, as such. So second half should definitely be far better, and yeah, I mean, we are not going to be seeing like super normal returns, but clearly what has changed over the last, I would say a few months, or let's say like 1 year or so, is that the central bankers all over the world have kind of stopped printing money. They've started adjusting their balance sheet. The rates have gone up. So in many ways, the easy environment for equity investments that we had seen over, let's say, from 2010 to 2020 isn't really there anymore. So we have to be cognizant, of that fact. Yeah, but having said that, I think now seems to be the time to start buying.
I was just wondering what's going to be the construct of the market, say, in the next 6 months to come? Because what one has seen is that there's been a stark underperformance from not just blue chips, but individual sectors, high weightage. And I'm not talking about the Adani group here, but I'm talking about something as large as banks and something as key as banks. Where do you think the leadership and underperformance is going to come in from, say, in the next 6 to 12 months?
See, what has happened with the banking sector is also that, in general, over the last 1.5 years, we've seen heavy selling from foreign institutional investors. And we've seen selling almost to the tune of around $30 billion, right? And what we've seen historically also is that when the foreign institutional investors sell, the banking sector typically ends up underperforming. But my sense now is that the foreign investor positioning in India is very, very light. In fact, I will go to the extent that to say that it is at the lightest level that I have ever seen in the last 10 years. Several large funds that we interact with are underweight on India. And the reason for them to go underweight over the last few quarters has been the extreme valuations. But as I mentioned, those things are correcting as we speak. So my sense is that from here on, the foreign flows should be on the positive side and not on the negative side. And that should primarily be one of the driving forces for the banking and financial sector, which is also incidentally the sector where the valuations have corrected quite significantly. They are trading at much below their last 10-year averages. So looks pretty attractive. Since you asked the question about the construct of the market, I clearly believe that it's the domestic cyclicals that should do better, which include banks, NBFCs. I would also say, industrials. In the near term, I would also be looking to own consumer staples as well. I think the concerns on monsoon being weak and therefore rural demand getting impacted, etc., to my mind, are overdone. We have to keep in mind that rural is not agriculture and vice versa. Rural or the bottom of the pyramid is far bigger than agriculture. I mean, agri GDP is about 16-17% of total. Rural is about 40-45%. So there is much more to the bottom of the pyramid demand than agriculture. And I think the non-agri segment, is basically driven by the other services, the construction services, construction sector, seeing pretty strong trends and pretty robust trend both on the infra side as well as the housing construction side as well. So yeah, so that's the reason why I would be adding staples here as well. And by and large, I still believe that the outlook for the global growth is has got worsened, and the domestic growth outlook is looking far better. So would look to overweight the domestic sectors rather than outward looking sectors.
Trade already at play, Mahesh. Just think about it. Banks have done well in last 1 year. Cyclicals have done well in last 1 year. Industrials have done last well in 1 year. Stocks like ABB, Siemens are trading at P multiples, which are almost nearing P multiples of consumer names now. So my point is that while there is a very strong merit in the case what you are making out, that is something, haven't markets already factored that in?
See, Nikunj, I am talking about very long-term trends here. I mean, if you look at the markets in the, let's say, the previous decade of 2010 to 2020, we had a pretty long history of those 10 years where many of the consumer-oriented sectors and the so-called defensive sectors actually did very well. And that was because the gross fixed capital formation, the GFCF, or what in more cultural terms called as the investment cycle, that has been running weak. Now that trend has changed. The investment cycle has started showing signs of pickup, led by the housing sector, and I think it's a trend that will continue over the next several years. So yes, what you say, what you're saying is right. That to some extent, we've seen some of these things playing out already over the last 6 to 12 months. But one should be focusing on longer term trends here. And my sense is that the last decade was the decade of the defensive sectors, the consumption sectors, etc. This decade is going to be for the investment oriented sectors like industrials, property, banks, etc. And 6 months or 1 year of performance should not deter us from moving away from there.
Okay. Mahesh, will it get bad for IT before it gets better, or bad will remain bad and IT will remain low?
See, the thing is, I do get this question, and many of the investors are inclined to add. And IT has actually done. I mean, IT stocks have actually done quite well over the last 3 to 4 months. Let's say by last 1 month. But my sense is that the news flow over there is going to remain choppy, and you will go through these cycles of valuation driven buying that will be coming in, but then there will be some fundamental negative, in the sense that some layoffs in the US or concerns on the US corporate profit growth, etc., will keep on emerging. So I think it's a sector that will remain range bound. There are obviously some very high quality names in that sector, but we still remain underweight there.
Whereas the other thing one is wondering is what happens to foreign institutional flows? Do they pick up anytime soon or not? Because we've seen as to how consistent FII selling has been in the last 3 months, year to date, in fact. And the money is clearly moving out to either other emerging markets or back to US equities. What would it take for the flows to return back to India?
Yeah, Aisha. So, as I mentioned, the foreign investor positioning in India at this point in time is at one of the lowest levels that we have seen. And in fact, I can tell you that, close to 100 plus investors that, I've interacted with over the last few months, more than half of those have been underweight on India. This is something has never happened. And so in that to that extent, I would say that the weightage correction in the foreign portfolios as regards their India weightage is concerned has largely been done, and from here on, it's actually a case for the India weightings to go up in foreign portfolios. So I would expect the foreign flows to be positive. Obviously, uh, one of the other factors that we need to keep in mind is what's happening in the global risk on risk off sentiment. If we see a few more negative news flow coming up in the financial sector in US or Europe, maybe it will put some near-term pressure on foreign flows, but that's more global. But from the India standpoint, I think the relative flows into India should be improving from here on.
Mahesh, what we've read and what we've analyzed over the years are these two very famous trends. Weakness in dollar index is always good news for commodities and emerging markets. That has not played out so far. And second, in a rising interest rate environment in the first cycle, equity markets, they always tend to go higher. That has also not played out this time. So why have these two mega trends, which are the trends of the decade, which everybody talks about, have not really played themselves out this time?
A very fair question, Nikunj. And I must say that the macro environment globally has been quite topsy-turvy. I mean, say like a month or month and a half ago, the global consensus was around the US rates remaining higher for longer, and there were some odd voices or noises coming towards the US Fed raising the rates up to even 5.5 to 6% as well. And now, in the last 1 month, things have changed quite a lot. And the consensus is now talking about a rate cut by the Fed as early as July, and possibility of more rate cuts during the remaining part of the year. So the point I'm trying to make here is that the global macro has been extremely volatile, and there have been some of those things which you would normally expect that haven't really happened. I mean, like for from sort of that point of view, what happened in most part of CY22. While the US rates went up from close to 0% to almost 4.5%. Ideally, that would be the time when the P multiples all across the world should have corrected, and those did, but to a very small extent. So many of those, historically, proven trends haven't really played out, and clearly it goes to show the risks, of the volatility in the global macroeconomic forecasting. So that's the reason, why I say that, if you just get down, to the fundamentals, I, do believe, strength in the, in the Indian economy. I do see strength in the investment-oriented sectors and, the parameters around that. So yes, there could be some ups and downs, but generally speaking, I believe this decade is going to be the decade of investment-oriented sectors like banks, NBFC, industrials, property, that will deliver better returns than the market.
Mahesh, if interest rates come down, which they will, now we are debating this quarter or next quarter, do you think there is merit in going back to growth stocks, whether it is a Zomato or whether it is a Paytm? Ultimately, interest rates act like a pivot for these valuations. Could there be a comeback in the fintech and consumer tech stocks?
Yeah, I think some of these tech stocks are looking interesting, and especially the long-term growth story is there for sure. Uh, but at the same time, we also have to keep in mind what's happening in the private equity world globally, and I think that remains one of the risk factors for the global tech stocks, not just the Indian ones, but also the global tech stocks as well. So, I think from a longer term perspective, maybe some of these names, make sense. But our view is that, we could be getting into, volatile times, from a near-term perspective, as far as that, overall, the tech industry grows. Obviously, some, of those names could be looking interesting, but I'm just commenting on the overall sector at this point in time.
Great to chat with you today. Thank you so much for taking the time out and joining in.
Thank you very much.
Okay, let's just take